Midnight in Washington. The dollar is already bleeding value in Asian markets. In Shanghai, cranes unload Russian oil tankers under military guard. Each barrel a direct challenge to U.S. power. Half a world away. Gold surges, Treasury yields collapse, and traders whisper the same rumor. Trump is preparing to slap China with sanctions so severe they could tear apart the world's largest supply chains. The last time America tried something like this, it backfired. This time, the stakes are even higher, the survival of the dollar itself. Just hours earlier, Trump doubled tariffs on Indian goods to 50%, a direct retaliation for New Delhi's continued purchase of Russian oil. India wasted no time responding. Prime Minister Narendra Modi confirmed his first visit to Beijing in 7 years, a move that goes beyond diplomacy. It signals a realignment. Washington's attempt to isolate India may have inadvertently pushed it closer to China, a pattern that echoes the earlier fallout from sanctions that drove Russia into Beijing's orbit. Trump's escalating stance on China isn't happening in isolation. The U.S. already levies tariffs above 50% on many Chinese imports, a pressure campaign that once slashed U.S.-bound Chinese exports by more than 30%. Even after partial truces, they remain down 21%. But here's the key point. China's overall trade hasn't shrunk. In July, it grew 7% year over year. In other words, China is selling more abroad, just not the U.S. Beijing has diversified its export markets and reduced its dependency on American buyers. That resilience undercuts a core argument behind the sanction strategy, targeting China's energy. Russian crude is central to China's manufacturing edge, fueling factories and lowering costs across sectors from EVs to consumer electronics. In July alone, China imported over $10 billion in Russian goods, much of it oil, subsidizing domestic energy prices. The theory is that cutting that flow would raise Chinese costs, weaken their exports, and choke Russian revenue in one stroke. But not everyone in Trump's camp is convinced. White House trade advisor Peter Navarro issued a rare public warning. Doubling tariffs could backfire. Many U.S. industries rely on Chinese components and materials. Disrupting that supply could trigger inflation at home. In short, if you choke China's energy, you risk choking America's supply chains, too. There's also precedent for how Beijing might retaliate. In a previous tariff standoff, China slashed exports of rare earth magnets, critical to defense, tech, and energy, forcing Washington to back down in negotiations. The leverage remains. Even the U.S. Commerce Department recently acknowledged the need to keep rare earth flows open, not just the U.S., but to global buyers who re-export to American markets. That's an open admission of dependency, and Beijing knows it. Here lies the contradiction. The U.S. push to reshore semiconductor production depends on those same rare earth inputs. Imports of rare earths jumped from 46 tons in May to 350 tons in June, yet that's still far short of what's needed for industrial-scale chip manufacturing. If China restricts exports again in retaliation, it could cripple the very industry Washington is trying to rebuild. Meanwhile, the currency backdrop is turning hostile. Since January, the dollar has lost nearly 9% of its value. Bank of America reports that fund managers are more bearish on the dollar than they've been in 20 years. The reason? As global trade shifts away from the U.S., fewer foreign entities need to hold dollars. Sanctioning China, the world's top exporter, could accelerate this trend. Ironically, the act of targeting Beijing may do more to weaken the dollar than any Chinese policy. Bond markets are already reacting. Futures data shows a 91.4% probability that the Federal Reserve will cut rates by 25 basis points in September. On paper, that's minor, but paired with trade disruptions, it could erode the yield advantage that has kept global capital flowing into U.S. Treasuries. If investors pull back, demand for dollars drops further, applying even more downward pressure on the currency. Let's pause here, because this is no longer just a trade war. It's a currency war, and it's one the U.S. may not be positioned to win. Trump's advisors tout potential tariff revenues, possibly $50 billion a month, once duties on semiconductors, pharmaceuticals, and other goods are included. That's nearly $1 trillion a year. But history shows who really pays. Consumers. Higher tariffs mean higher prices. It's essentially a tax, just collected at the border. The political pitch is that tariffs protect industry and fund national investment. But previous windfalls, from the 2008 bailouts to 2020 pandemic relief, largely flowed into asset markets, widening the wealth gap. The risk now is that once again, households bear the cost, while the strategic gains remain uncertain. If this pattern holds, the very voters' tariffs are meant to help may see little benefit, while asset owners consolidate their gains. Corporate investment pledges have become another key pressure point. Trump frequently cites commitment from Apple, $600 billion, NVIDIA, $200 billion, and TSMC, $100 billion, as evidence that his trade policy is attracting capital. But these are forward-looking promises, not guaranteed expenditures. Political uncertainty makes execution risky. If even a quarter of those investments stall or shrink, the projected job creation, estimated at 400,000 new positions, could evaporate, undermining the economic case for sustained high tariffs. The Federal Reserve's leadership is also shifting, potentially tilting the board further. Trump's nomination of Stephen Miron to replace Governor Adriana Kugler would put pro-tariff, weak dollar advocate in a critical seat. Miron was the author of the so-called Mar-a-Lago Accord, which called for dollar devaluation as a tool to fix trade imbalances. Pair that philosophy with elevated tariffs, and a likely result is imported inflation, especially in sectors where domestic production still can't meet demand. UBS strategists have warned that labor market softness, coupled with changes to the Fed's composition, puts the dollar-negative narrative firmly back in play. Friday's jobs report showed hiring continuing to slow, intensifying pressure for interest rate cuts. If the future Fed becomes more open to deliberately weakening the dollar, global investors may begin exiting U.S. assets early, accelerating the very currency retreat Washington is trying to contain. China's options for retaliation extend far beyond rare earth exports. It could expand yuan-denominated commodity contracts, accelerating the ongoing drift away from the dollar in global energy trade. Coordination within BRICS could amplify that trend. Already, non-dollar trade between Russia and China is increasing. These steps may seem incremental now, but if sustained, they gradually erode the network effects that keep the dollar dominant. There's also a consistent geopolitical ripple effect. Unilateral U.S. tariffs have a history of pushing target economies closer together. Brazil and India, both now facing steep U.S. duties, have already discussed joint responses within BRICS. Brazil's President Lula has publicly proposed a coordinated trade strategy to counter Trump's tariff campaign. If Beijing joins such an initiative in response to new sanctions, the combined economic weight could form a parallel trading bloc too large for Washington to isolate. For all the talk of U.S. leverage, global interdependence remains. Yes, American consumers still represent the world's largest buyer base, but that dominance erodes bit by bit every year. Tariffs that reduce imports also reduce exporters' incentives to prioritize U.S. markets. And once trade routes shift, they rarely shift back. That's the irony at the heart of this moment. Targeting China's energy supply to weaken its exports could just as easily undermine the inputs critical to American manufacturing. Weakening the dollar to help U.S. exporters risks undercutting its status as the global reserve currency. Building a domestic chip industry to reduce reliance on China still requires Chinese rare earths. Every move comes with a built-in countereffect. Now, picture the closing scene, the Fed boardroom, 2026. The dollar is worth less abroad than at any time in modern history. American factories are running, but at higher costs. China continues importing oil from Russia, only now it's paying in yuan. And the rest of the world? Watching, waiting, preparing for the next time Washington reaches for the same economic playbook, wondering whether the end game was always inevitable. Because if these sanctions go through, the real question isn't whether the dollar survives this round. It's whether it survives the next. Behind the headlines, a quieter shift is already underway. According to SWIFT transaction data compiled by the Bank for International Settlements, the dollar's share of global trade finance has slipped to 51%, its lowest level in over a decade. Meanwhile, the Chinese yuan has climbed to a record 6.5%. That small seeming shift represents billions in contracts switching currency allegiance in under a year. Energy is the spear point. Bloomberg reports that Saudi Aramco finalized a $10 billion petrochemical investment in China to be settled partially in yuan, locking in non-dollar oil flows for at least 2 decades. If sanctions push Beijing to expand this model, entire commodity chains could migrate out of Washington's financial reach. And here's the kicker for markets. U.S. Treasury auctions in July saw the weakest foreign demand since 2011. Primary dealers were forced to absorb $48 billion in unsold debt. This isn't just a signal, it's a warning. If foreign buyers pull back further, the cost of financing America's debt could spike rapidly, triggering credit downgrades, market sell-offs, and political backlash in a single sweep. The fuse is no longer hypothetical. It's lit.